Welcome back to Investing Talk podcast.
Today we're looking at Beyond Meat.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis of Beyond Meat. Look, the immediate, the inescapable takeaway from the recent information is that the company is facing some severe, really foundational operational headwinds.
And these aren't just, market wobbles, right? These are deep structural issues.
Exactly. And we know that because of their latest disclosures.
Right. The biggest distress signal has to be that failure to file their quarterly report on time. They put out a notice called a Form NT10Q. For anyone listening who doesn't track SEC filings, an NT10Q is basically the company saying, hey, we missed the deadline because something major went wrong in our accounting.
That's it, exactly. And something major they pointed to was a material non-cash impairment of certain long-lived assets.
Okay, so in simple terms.
In simple terms, the company looked at things it owns, factory equipment, maybe some intellectual property, and realized those assets are worth way, way less than they originally paid. They had to take a massive write-down.
Wow. That's fascinating because it suggests the investments they made, maybe thinking this huge demand growth was coming,
have utterly failed to materialize.
Yeah.
It's a painful admission that a lot of their past expansion efforts are now just sunk costs, basically worthless on the balance sheet.
And it really speaks to a massive overestimation of, well, everything, market adoption, efficiency.
It does.
Yeah.
But the problem, it actually goes deeper than just the asset values. In that same filing, they also disclosed a material weakness in internal controls over financial reporting.
That phrase alone sounds incredibly scary for an investor. Can you just unpack what material weakness really means here?
Absolutely. This isn't a simple typo in the books. It's a flaw in the fundamental infrastructure of how they track their money.
In the plumbing itself.
Right, the financial plumbing. Specifically, they found the weakness in how they handle complex transactions. And that tells us their numbers are just inherently less reliable until it's fit.
So even though management says they're working on it, it raises some serious questions.
It absolutely does. It elevates the company's risk profile significantly.
And if we connect that weakness and the asset write-down to the actual numbers, the picture gets even darker. We saw some severe margin compression.
We did. The net losses in the third quarter just widened sharply to negative $110.7 million.
And that's compared to what, about negative $26 million just a year ago?
A year earlier, yeah. So that's almost a fourfold increase in losses. It really reflects that dual pressure of rising costs and, frankly, waning demand.
They're selling less, and it's costing them more to make what they do sell.
That's the trap they're in.
And the natural consequence of burning cash that fast leads directly to the next critical issue, which is liquidity and dilution risk for shareholders.
Precisely. They are scrambling for cash. You can see them aggressively working with lenders, amending financing terms, basically doing anything to manage their capital and avoid a crisis.
And that desperation, unfortunately, led to some pretty notable shareholder dilution just back in September.
Right. They issued warrants for over 5.7 million shares to a strategic partner, Unprocessed Foods.
Think of it this way. When a company does that, they're taking the existing pizza, the company's future profits, and just slicing it into many more pieces.
Exactly. So every share you owned before now has 5.7 million more potential claims on any future earnings. It's a huge red flag that just screams they're in need of capital.
It's a really tough spot to be in, especially for a brand that was supposed to be all about high growth. Their revenue for the last year is only sitting around $290 million.
And that number is contracting, not growing. They're selling fewer products at fewer outlets. It's a tough story.
Which brings us to the competitive landscape, which has, it's shifted dramatically. Beyond Meat was the pioneer, right? They had that first mover advantage.
They had a huge moat, or at least it seemed like it, but that moat is narrowing, and it's narrowing fast.
So what caused that? Was it just internal mistakes, or did the competition just get a lot smarter?
It's a mix, but competition is a massive factor. Other alternative protein companies, even the traditional food giants, they've all caught up on taste, on texture, and this is the crucial part on price.
The novelty has worn off.
It really has. Now consumers are just looking at value, and Beyond Meat is losing ground in those key retail and food service markets.
So if the foundation is shaking and the competition is brutal, what's management's playbook? They can't sell a growth story anymore. This is pure turnaround mode.
It is. The focus now is just on stabilization. The CEO has been clear about three priorities. First, sizable cost reductions.
Accessible.
Second, investments to get their gross margin back up. And third, very targeted strategic growth initiatives.
That sounds a little bit like corporate jargon for cut costs, make more money, and throw some darts at a wall. What does that mean in reality?
It could mean anything from shuttering facilities to mass layoffs. More likely, it means product portfolio rationalization.
So just cutting product lines that are dragging them down.
Exactly. And that's where the speculation starts. We're hearing rumors about entire product lines being scrapped because they're just not profitable.
And then there's the high-stakes rumor that suggests maybe even management isn't sure about the current path.
Precisely. There's chatter about potential leadership changes. The board is looking at every single option to speed up this turnaround.
A CEO change would be a huge signal.
A huge signal that they're making a radical departure from the strategies of the past. It's a massive risk, but it could be the catalyst they need.
Okay, here's where it gets really interesting for anyone watching the stock, because there are 5 massive signposts coming up in just the next 3 months.
The first and most crucial is that delayed Q3 10Q filing. It's due November 27th, so very soon.
And investors won't just be looking at the final loss number. They'll be scrutinizing the details of that asset impairment and, more importantly, any progress on fixing those internal control weaknesses.
That's the critical piece. This filing isn't just about how bad Q3 was. It's about how trustworthy the new numbers are. It's about rebuilding trust.
Then we move into December, and there's a big external event. The major ETF index rebalancing on December 15.
And this can have a huge impact. Given the stock's current size and volatility, index rebalancing forces large passive funds to buy or sell massive amounts of shares.
So it can drive huge trading volume and price swings that have nothing to do with whether the company is actually doing better or worse.
Exactly. Then, right before Christmas, we get a really essential demand check. The holiday sales performance release is expected around December 24.
This is so vital. It's the first hard data we'll get that shows if they manage to stabilize sales during the holiday season. A bad number here makes a recovery in Q1 look much, much harder.
Then, as we get into the new year, around January 10, we get the institutional 13F filings.
Right, this is like pulling back the curtain to see what the big money managers were doing.
It tells you what the hedge funds and other major institutions did in the fourth quarter. Were they buying the dip or were they getting out completely? It's a huge sentiment indicator.
And the final moment of truth for the entire turnaround strategy will be the Q4 2025 earnings in mid-February.
That's the final judgment. It's where we see if those sizable cost savings actually worked or if the decline in demand just overwhelmed everything else. It really sets the tone for 2026.
So let's shift from the brutal fundamentals to the technicals, because there's a fascinating contradiction here.
There really is. Fundamentally, everything we've talked about, the debt, the losses, it's all screaming sell.
And technically, yeah, the stock confirms that. It's trading way below its 50-day and 200-day averages. But the short-term indicators are telling a completely different story.
They're screaming that the stock is deeply oversold. We're looking at the RSI, the Relative Strength Index, which is down around 36.92.
And the stochastic reading is incredibly low at 11.21.
For anyone listening, these indicators basically measure how fast the price has been falling. When they get this low, it suggests the selling pressure is exhausted, and a technical rebound is statistically pretty likely.
Even if the fundamentals are still awful.
Even then, the price action becomes less about value and more about technical pressure just reaching a breaking point.
And, I mean, look at the volatility. The 3-month range is just insane. From 50 cents all the way up to $7.69. It closed recently near $1.
Current sentiment suggests a pretty tight near-term trading range.
Yeah.
We see support around 80 cents and resistance at $1.60. The average analyst target, interestingly, is just above that at $1.70.
And all of this is being fueled by that intense retail sentiment. The stock behaves less like a food company and more like a high-octane speculative play.
It's driven by meme stock dynamics. You hear constant chatter about short covering rallies because the short interest is so high.
And that creates just extreme volatility. The beta is a sky-high 2.49.
Which means if the overall market moves 1%, this stock is expected to move almost 2.5%. That's what creates this high-risk, high-reward setup for traders.
And this volatility ties directly into the biggest, most speculative rumors out there. The talk of a strategic partnership or even a potential buyout.
If the stock falls far enough and the brand name still has some value, a much larger player might decide to just acquire the whole thing at a distressed price.
And if those rumors ever prove true, the price wouldn't just test that $1.70 resistance.
It could blow right past it. That's the huge, albeit deeply speculative upside that keeps aggressive investors at the table, even while the fundamental house is on fire.
But we have to end by just clearly stating the three core risks here.
We do. First, the acute risk from shrinking U.S. sales is a real present danger. Second, the ongoing threat of dilution and cash burn is putting huge pressure on existing shareholders.
And third, the sector itself is volatile, and that's being amplified by the current macro trends. This company is skating on very, very thin ice.
So what does this all mean for you, the learner? The fundamental conflict here is that you have a company in severe operational and financial distress.
But it exists inside a plant-based food sector that is still structurally poised for long-term secular growth. The industry is growing, but the company is shrinking.
And that's the ultimate question for any investor watching this. Can the current management team stabilize the foundation, stop the catastrophic cash burn, and fix those internal weaknesses before the window of opportunity for a long-term recovery just passes them by completely?
It is definitely a high-risk, high-reward situation, and it requires extreme scrutiny of those upcoming dates we talked about. Remember to subscribe, like, and comment to stay informed on these critical market shifts and high-stakes opportunities.